Hello, everyone. Thank you for joining today's webcast on ESG. Why are we still talking about this? My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our session. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we'll hold your questions till the last part of the program. Additionally, in the handout section, you will find a PDF of today's presentation. Today's webcast is sponsored by BNY Mellon. To introduce his firm and today's webcast, we have with us Robin Webe. Robin is a senior portfolio manager for the Global Natural Resources Strategy, which he designed and launched in 2008. He is also a co-portfolio manager of the All Caps and Diversified Equity Strategies, and he is a member of the global research team responsible for providing sustainability and resource insight into the organization. Robin, I'll turn over the session to you now.
Thank you, Hank. Thank you, everybody, for your time today. I'm really happy to be here and excited to be talking about ESG and representing BNY Mellon. ESG, why are we still talking about this, right? So it's a critical risk assessment framework, and we'll talk about that in a minute. And then we also want to discuss, what has the pandemic really shown us and taught us about how we think about ESG from an investing perspective. And so on the next slide is a quick introduction to BNY Mellon. The BNY Mellon is a global investment company dedicated to helping clients manage and service their financial assets through investment lifecycle. Whether providing financial services for institutions, corporations, individual investors, BNY Mellon delivers informed investment management and investment service in 35 countries. As of March 31st, 2020, we are huge with 35.2 trillion in assets under custody and administration, 1.8 trillion on assets under management. And so as you can see, we're an enormous financial institution with a lot of reach, but we do provide a lot of customization for our clients. And we also act in good stewardship for our clients. And ESG is an absolutely appropriate topic for that. And as we move on to the next slide, I wanted to, begin with the discussion on ESG and the framework. And, we'll transition this into basically how do we see this framework, how it's applicable today, and what's different with pandemic. And quite honestly, we're all living a very different experience today with the pandemic, right? We're all taking this from here. You can see my beautiful little home studio here, and Frances is from her place up there in upstate New York. And it's been hard for a lot of us. I have 3 young kids. I'm living a very different experience. Just this morning, it broke my heart to see all 3 of them crying through the window. So finally, before lunch, I actually let them come inside for a little bit. So that was, I thought, a nice bit of just a little pandemic humor for you. Let's keep it light. So ESG framework. So the ESG framework is essential because it allows us to take a look at some non-financial risks that have always been there, but up until now, we didn't really have a way of thinking about them or quantifying them. And so the ESG framework, it's an acronym. E is for environments, S is for social, G is for governance. Governance, G, it's tough in this conversation because in theory, we've always been doing governance work. We should have always been looking at controls within companies, incentives, and comp structures and all of that. So a lot of the focus within the ESG converse tends to reside with more of the E and the S issues. But again, these are all thinking about holistically, what are the non-financial exposures that a company has that could impact its valuation or performance? So the environments, right? What is the emissions, water, or waste profile of the company? If they're emitting a lot or using a lot of water or generating a lot of waste, it may be a small cost today, but there's a potential for a large liability if they're not doing it properly. From a perspective, similar issue, right? We want to have equality and access, and a lot of companies will talk, do they walk the walk? Because if they're not providing equality and access and being good stewards of the community in which they operate, all of these things can have a massive impact on that enterprise's future and ability to generate profits. So an enterprise have associated risks and what potential liabilities could be realized. From the perspective of ESG, what lethal liabilities could be lurking around the corner? Move to the next slide. We can talk a little bit more now. Let's slide a cue there. So, yeah. So, why is this important stuff? And so, we're going to go back up one slide to slide page here. Thank you. Thank you. So then the ESG is really about thinking about long-term success, right? Because when we're looking at a company, as Wall Street does, we're typically focused on a very hyper short term, right? What was the earnings profile, the EPS report, earnings per share in 90 days, 3 months, right? So a lot of you is looking at profitability or getting better, or is growth going down? How do we think about these? So really focusing on the minutia there. But the reality is a lot of non-financial risks out there, they don't manifest themselves in these 90-day periods, right? And at some point they turn into a liability. But if you're not managing these things and you only focus on the short term, you might be making a mistake for your long-term success. So you look at ESG to think about, it's great to have profitability and growth going within 90 days, but if you're not managing your environmental risk, your social risk, if you don't have good governance in place, inevitably you're probably going to creep into a lethal liability at some point in time and jeopardize long-term success. So why ESG? That these first sustain, you heard ability as kind of the vernacular in the ESG discussion. Sustainability, opposite, right? Want sustainability, obvious reasons that these companies can keep going. So we need to look at the entire framework, not just the financial results, but the entire risk profile of the company beyond the non-financial, because those environmental and social behaviors could become real cash liabilities. And oh, by the way, performance tends to be, quality tends to be virtuous, right? So if you have good controls in place that were put in place by a thoughtful management team, they'll probably have a quality decision-making process, and that can be very positive feedback loops. They'll have less accidents has more engaged employees, more engaged employees are more productive. So you get a very positive feedback loop. So it's important to look at these things because in some ways, these may actually be better predictors of success than last quarter's margins, right? And so we think about this, right? We look at from a perspective, how do you even benchmark these things? We look for industry leadership, right? Because essentially, when you're looking at the performance of a company, they may be racing, who's earning more profitability faster. What does their non-risk profile look like? Are they industry leaders? Because if they are, at some point, they catch up and outperform their competitors. But additionally, if you think about bad environmental and social behavior, we're talking about these things as externalities because there's no price tag on them. We don't know when they may happen. We may have an accident, or the other side of this too is regulatory regime, right? At some point, you may be taxed for your carbon. You may be taxed for not providing employees appropriate access and good welfare. And so the good ESG practice means long-term success. It means you won't have lethal liabilities. It means your whole enterprise is working on a very positive feedback loop. It means you have industry leadership and you have a head start on regulatory. So for us, ESG is really important non-financial metrics because it enables us to look at the entire enterprise, because beyond the financial metrics, there is still a lot of risk and opportunity to consider. So ESG performance relates to all the quality of the enterprise as it manages all of its risks, right? So it's really thinking about the entire profile of a company. On the next slide, we're going to look a little bit more specifically here at, why are we still talking about this, right? And so this was kind of the teaser for the presentation. And what's interesting is because there have been some things that have come and gone. And so some of us who've been close to this are familiar with SRI, social responsible investing. And for some folks, that was a fad. It came and it went. There's still folks who do, but it came and it went. And so people are like, oh, just another fad that's going to come and go. Is environmentalism a fad? Well, that's a ridiculous question to ask. But ESG is not a fad because essentially it's a framework. It's not about values, right? We're not talking about, it's good to do these things. We're saying literally there are real financial liabilities you will recognize if you don't deal with this, right? So ESG framework is not espousing values. It's about non-financial facts. I'm not telling you that, emissions is going to cause global warming. I'm telling you you're emitting too much, and at some point you will have a tax on those emissions, and that'll be a real liability for your company, right? And so it's not about values. It's not going anywhere. We're not going to change values or change opinions. It's about a framework. I like to think about this as kind of like cash flow, right? There was a point in time when people didn't think cash flow was important. They just cared about the income statement and the balance sheet. What am I earning and what am I saving in the bank? But we all know that cash flow can be an enormous predictor of the success of income statements as well as balance sheets. Same thing here. So this is a framework that we're talking about non-financial facts. It can be applied to all organizations, right? We can talk about literally any company. It may be a different topical area we care about, but Everyone has an environmental footprint with different degrees of materiality. Everyone has a social footprint, again, different degrees of materiality, but we can apply it to any enterprise. And what's also nice to think about this is to the extent that there is any sense of values or people feel their values in there, it's aligned with the cultural movement set by the UN. The United Nations has their Sustainable Development Goals. I think it's 2015 when they first published those, or 17, I can't remember. Sorry, apologies. But when the UN published these, they put together these 17 Sustainable Development Goals. The entire has agreed are things we should move forward, right? Ending poverty, ending suffering, ending starvation. And so ESG is actually taking a different perspective of all of these and looking at them as risks. If you don't solve these, people are going to be upset, and there's probably going to be some sort of a liability related to them. Again, so the reason why this is still here today and why it's not a fad is because it's a framework. It's a way of looking at an investment or an organization and trying to analyze what is the total risk enterprise. We can see the financial, but what are the environmental and social things that may happen on the out years that could impact the enterprise? So again, like I said, this, in my estimation, in a few years' time, will be as important to investors as cash flow analysis. Moving to the next. So ESG in the pandemic. Sorry, I have a student. All right, close the door, please. Thank you. So the ESG in the pandemic, and so what's been interesting about the pandemic is, it has really actually focused us pretty sharply on social issues, right? Because up until now, ESG was interesting and it was very topical, but primarily on the E side. We knew social was important, but E, we're literally going through billion-dollar storms on a regular basis now all over the world, right? And so I think it's very hard to argue that we don't have environmental issues. But the pandemic has very quickly showed us we also have a lot of social issues, right? There's a very real difference between people who can earn an income on a laptop and those who cannot. It is a completely different economic experience for those demographics. And so talking about the resiliency of an enterprise, have they been able to mobilize their workforce? Have they treated everybody equitably? Are there companies where the CEO goes home with his laptop and he's staying safe there and all his employees are out on the front lines every day? So we're really looking at a lot of social issues. So ESG, in my estimation, is actually getting accelerated from this pandemic. It's also causing us to reflect on the environmental footprint, mostly because no one's going anywhere and we've really dropped the emissions profile, right? And so that's very, very interesting. However, we haven't solved emissions with us all staying home. This isn't going to be permanent. I don't know about you, but as soon as I have the chance, I'm going to drive very far away from this house and get some air between me, right, and my family. So we will start driving and transporting again. As that happens, we will be consuming fuels again. Emissions will go back up, maybe not as high, but gosh, we've had problems for years now. So we will be back in problems all over again. Excuse me. But what's interesting about this is I was worried that we would see actually a deceleration of the environmental movement because of this, because it said, hey, the pressure's off. But if you watch what every single company has done, everyone who has cut capital spending has done it primarily in brown stuff and outdated stuff. They've only been investing in keeping the programs in green and new stuff because, right, they see regulatory regime as getting harder, not easier. The new stuff, the green stuff, is also more efficient, which means it's also economically advantaged. And so in some ways, we've actually shifted the spend proportionally even more in the direction of green. And so now with the pandemic showing us some social glaring issues, right, in addition to all the things happening in the streets across America today, right, social issues are in the forefront, environment is back in the forefront again. And so my estimation is the pandemic is not slowing ESG down, is actually acting as an accelerant. So social challenges became evident and environmental awareness has passed its tipping point. The opportunity for investment has only increased. And so as an investment manager, now we get excited because now we have a new theme. We don't just watch the Fed flexing mortgage rates, making less and more houses, right? We now have something to go after. Sustainability, growth, infrastructure, social issues. On the next slide, please, we'll talk a little bit about how we kind of manage this over at Mellon. And so, in Mellon, at BNY Mellon, the entire enterprise, we do a lot of ESG work. And we spend a lot of time, especially in the last 12, 24 months, really formalizing and communicating how we do it, because it's really important to think about. And our belief is that to be properly integrated with ESG research, in order to be properly doing ESG research, it needs to be integrated with the folks doing fundamental research, right? What we don't want to see is an ESG department. If you have an ESG investment departments, typically that means all the other analysts are saying, I don't know, that guy will figure it out. I don't want that to happen in our organization. What I want is all of my investors, my entire team, whenever they're looking at any company, to be savvy enough to know that ESG completes the entire risk profile of that investment. So that to me is proper ESG analysis, and that's what we have here. It's integrated into the research because it's a necessary risk assessment. We don't have ESG specialists because it's the cool buzz thing to do. And now, oh, those guys have degrees in ESG. Yeah, but do they have degrees in covering companies like Amazon, Netflix, right? So when you're looking at these companies, ESG matters for everybody. And so we want everybody thinking about it. We do specialize within those sectors when you integrate that research where the issue matters the most. So I primarily work in natural resources. So for me, it's the climate. So I spend a lot of time on ESG issues specific to the climate. We do ESG council because we need someone who have a bit of coordination. Hey, I heard this here. That guy's looking at this. There's a resource for climate. So we do that. But the reality is I'm the one doing that risk assessment when I'm looking at oil and gas companies, because that's where it's most material to my companies. We have folks in the other industries, for instance, the consumer, right? The consumer is thinking about this from every perspective, because if you have a bad brand, because your supply chain, right, you're bringing your clothes to the store, but it's child labor is involved, you have a high emissions profile, you're generating a ton of waste, huge issue for the company. So the consumer analyst needs to be savvy on those topics as well before they can recommend those investments. So that's what we're talking about. And what's really nice about BNY Mellon, because of our scale, as we discussed earlier, it wasn't just bragging. I wanted to highlight we have the ability and the inclination to engage. It's not enough to say, okay, that company stinks, we're walking away. We do that a lot, but there are times like, oh gosh, this company, they got everything right. If they could just get their emissions profile a little bit better, I think this would be a phenomenal investment. And so that's what we do. When we are involved with investments that we think we can help them, we are not shy to get involved and engage with them. We believe that is the appropriate way to do ESG research, be integrated. So investing organizations like Mellon have embraced and implemented this risk analysis framework across the entire enterprise, but we make sure that make sure it sticks, we have engagement, and our clients couldn't be happier with this approach to ESG. With the next slide, I'm going to hand it over to Frances to discuss more.
Thanks, Robin. So Robin represents some of the investment management strategies within BNY Mellon. I'm within the Global Risk Solutions Group within BNY Mellon that supports many of our institutional custody and administration clients. So I'm often representing clients that are trying to evaluate their investment programs across multiple managers. And so the perspective of Robin in terms of how you specifically focus on managing and selecting the securities within your portfolio, that is a very specific and highly valued skill set. Many of our clients that we work with are challenged with some of the need to develop the expertise, the need to define ESG, both in the context of the industry and what's important to their specific firms. And so one of the reasons why we're still talking about this is regulators are still talking about ESG. And definitely different regulatory frameworks have different speeds with which they're focusing on this, and they're all defining it differently as well. I would say Europe is probably farther along in defining some of the requirements for ESG, and so many of the global asset managers that also need to comply with the European frameworks are also thinking about, how does that apply globally and to their U.S. clients. So the European requirements, even though they are not necessarily relevant for the U.S. pension plan sponsors, I would say that there tends to be a regulatory convergence over time, and what one regulatory region is focusing on, other regions do then pay attention and begin to focus on it over time. So to some extent in the US, we can think of some of the European views as sort of an early indicator of some of the kinds of questions that we need to be prepared to address. And one of the useful things that's coming out of the EU is some suggested frameworks. So to try to address one of the fundamental challenges that everybody defines ESG differently. So Robin, you were very clear in thinking about the ESG definitions from the perspective of Mellon, particularly since that's your area of focus around the environmental and the natural resources. When we work with clients globally in Europe, a lot of the focus for many years has been environmental. In the US, the focus really, the definition of ESG that was relevant to more of the clients has been around governance. And so that is an area that I'd say the US is probably very advanced in terms of thinking about particularly the relationship between governance and returns. And so that's, before this quarter, I would say, or before this year, that was the most common definition of ESG that our clients in the US were interested in. And then in Asia Pacific, often it was more the social definitions that were at the forefront of their investment programs. But that said, within, even within the US then, and even within public plan sponsors, from one state to another, the specific constituents are going to have different issues, based on the economic drivers for the state, based on the demographic makeup of the population. So there's going to be different definitions of ESG that are going to be relevant. And as headlines are continually changing, the definitions that are going to be topical are also going to change. So my point with going into some detail with this is that I don't expect there to be a convergence in the definition of what ESG means to any individual institution. I do expect convergence in terms of the kinds of disclosures that will be made available both from issuing companies as well as from investment managers that describe their strategies, as well as in many cases from asset owners and institutional investors. In some regions already need to disclose their specific, environmental risks or some of the other dimensions of ESG analysis. So the specific regulatory focus for a lot of the public pension clients in the U.S. is around the ESG and the DOL requirements, even though that's not exactly the focus of public pensions. There's an awareness of the ERISA requirements, and kind of it tends to go along with the same sort of fiduciary responsibility that ERISA suggests. Now, unfortunately, the ERISA guidance with respect to ESG has not been very clear. There's maybe the good news version of that is that it is a bit open to interpretation. It's more around the not restricting, provided you can prove that it's not harmful, but you are allowed to focus on it. And so the best I can say, and I'm not a lawyer, so please do consult your own attorneys to get the specific requirements for your institution. But as long as you can have a view of the financial returns or the financial benefits alongside the non-financial objectives, there does appear to be permission to consider the ESG factors as a component of an overall investment program. So that's very carefully worded, and that's also fairly consistent with how the CFA Institute suggests aligning the ESG interests with fiduciary responsibility. So, and it definitely changes with the different administrations. It is interesting to look at the history of the guidance statements that have come out over the years. And to see the framing of, you're encouraged, you're discouraged, prove that it will hurt, prove that it will benefit. You don't have to prove that it will, there's a lot of nuances to it, and it's interesting to follow along. And so currently in Europe, public or pension sponsors need to make sure that they are disclosing some of the ESG factors as a component of the investment program. And in the US, you have to, if you are, you have to explain why and prove that it's prudent. So it's an interesting dynamic, and it continues to evolve over time. And I'm going to invite Robin to comment and chime in because I know you've had to deal with this over time as well. So this is something that continues to be a very specific decision that you need to make sure that for your specific institution, there's a clear understanding of the definition, the regulatory framework, and the appropriate actions to take in this context. So new news with this, the SEC just last month published something that is not, yet regulatory requirements, but it's a hint of things to come. And so this, I think, would be relevant, particularly for any public pensions that have any kind of defined contribution structure. There was a recommendation that the SEC is suggesting that they begin to require disclosures. So I do think that this is going to indicate further regulatory involvement in the US over time. I don't say that we are leading the world, but I do think that there's going to be more that's going to come out that will be requirements that US investors will need to be aware of. So stay tuned, more to come for sure on this topic. So if you look at the next slide, then some of the ways that institutional investors are currently thinking about some of the ESG interests. As Robin mentioned, for many years, the most commonly understood definition of ESG was socially responsible investing, where the definition of ESG was restricting investments, and exclusionary screens where you would say, I'm not comfortable with this particular issue, and therefore any company that invests in this particular topic, sometimes formally called sin stocks, there have been many different formulations over the years, but it was previously understood to be that the definition of ESG was restrictive investing. And Robin and I had a bit of a debate in preparing for this presentation in our own, consistent definition of ESG. And so for me, I think of ESG as the umbrella framework under which there are many different approaches to ESG investing. And one of the approaches continues to be the investment guideline monitoring. And that's not necessarily, in all cases, prohibited investment. Sometimes it is. In some cases, it's sort of a watch list or an awareness of where there might be a particularly visible risk factor associated with a particular kind of investment that is of importance to a specific institutional investor. So Robin wanted to call that socially responsible investing and say, no, change that to socially responsible investing. So I left it as ESG. So, this is the debate in action. So some of the other approaches then to ESG investing are proxy voting and engagement. And so that is something that is, of growing importance, I would say. There is ongoing recognition that the investors do have influence over the actions of the companies. It's not only the proxy voting that is the mechanism that you can use to have engagement with companies. There are also services that and many managers do provide this, that is, active dialogue and active discussion with management teams, not just in the context of proxy voting. So engagement, active engagement and proxy voting is one of the levers that many institutional investors are actively involved in thinking about ESG issues and ESG investing. Performance and attribution and risk are all dimensions of ESG analysis. As Robin indicated, if ESG is one of the factors that is considered in fundamental equity and any investing analysis, then you can do some of the usual math on the investments in terms of thinking about what is the performance of the investments that have particularly high or particularly low factors associated with a particular issue. You can think about attribution or contribution to return in the context of, well, how much of my return for a particular, say equity composite is due to investing or not investing in a particular risk factor. So we worked with one client recently that was needing to ask the question, if we exclude a particular type of investment, or if we tilt our investments towards or away from investments in a particular carbon producing sector or type of investment, what would that do to our return, positive or negative? Or what would it have done had we made the choice last year to modify investments? So thinking about ESG issues in the context of financial performance is something that is particularly important, I would say, for institutional investors in the US. And risk then is another word that requires definition. It means something different to everybody. But there are elements of ESG analysis that can factor into any kind of risk framework. So we work with some clients that are looking at ESG risk in the context of decomposition, value at risk decomposition. So thinking about the particularly high or particularly low scoring security buckets from the perspective of how much did they contribute to an overall volatility of the plan, how much do they contribute to value at risk of the composite over a period of time. So there's a lot of different definitions of risk, and any of the types of investment analysis you can apply to various ESG definitions. You'll notice I skipped ESG ratings data vendors because that is one of the fundamental points that feeds through all of the kinds of investment analysis. And that is one of the challenges and one of the opportunities. The definitions of ESG ratings is something that is an important consideration for any firm that is thinking about developing your own ESG program. Many investment managers subscribe to multiple ESG data vendors, and then often independently have their own view on top of the market available data. So the result then is that there are many different definitions of ESG ratings and many different approaches to what constitutes a positive or a negative risk factor. So if you look at the next slide, then I mentioned the exclusionary screening or the socially responsible investing definition of ESG. So this is the type of ESG analysis that has the longest history. And so just as an illustration, we pulled out this visual that demonstrates some of the most commonly monitored ESG issues within our current clients' investments. And so in many cases, these are some older topics, I would say. These topics have been in the news for a long time. The environmental topic is not the largest, it's not the most frequently monitored issue, but I would say just in the trends of what we see, that's probably the area that's growing the fastest in terms of the number of screens, the types of analysis that our clients are interested in monitoring. So just a view of what do other people monitor when you think about ESG. And the growth in the investments that are monitored with this particular type of analysis has definitely been growing significantly. And the dimensions that are not even measured with this then are the growth in investing of the strategies that have ESG as part of the integrated analysis. That's a much harder number to monitor because if ESG is just one component of fundamental equity analysis, then conceptually any strategy is an ESG strategy and any investor is an ESG investor. So I often have difficulty asking the question of like, what is the growth in the market? Well, it depends. Are they an ESG investor or not? Like, well, what do you mean? So it depends is going to be my answer to everything now. Next slide, please. So in the context of data, so I'm sorry, Hank, can you switch to the next slide? Perfect. So so within BNY Mellon, my group, as I mentioned, supports a lot of different institutional investors, and our goal really is to help our clients with their investment programs and help them monitor the effectiveness of their programs. So one of the things that we do then periodically is work with our clients to understand what are some of the things that they would like to do but are currently having challenges doing. So ESG is one of those topics that many more people are interested in ESG investing than are currently pursuing active strategies for a variety of reasons. One of the reasons is lack of education and resources. So if you don't have an ESG specialist group, if the intention is that everybody needs to be ESG experts, it's going to take time before the industry develops that level of baseline expertise so that there's a comfort level to talk with the same language, to understand the same issues. So that's one fundamental challenge that we see in the industry. But let's say then that we get past that challenge and there's education that is made available, and certainly there are educational resources for this. We're certainly happy to work with clients to the extent that we can share what we know. We can direct you to some other tools that we found. So this is a solvable challenge. The data challenges, I would say, do need more development in the industry before we could say they are solved. So some of the ways that our clients are dealing with data challenges today are, as I mentioned, many of the investment managers subscribe to data from multiple ESG ratings vendors, and then they need to also apply a layer of deep analysis to compare the ratings for the same issues from multiple vendors, to overlay their own proprietary views on top of the data from vendors. So it's a pretty big challenge to try to deal with the variety and the disparity of data about ESG. So some of the challenges then that we talked about with clients that are common challenges are the need to focus on specific factors. So if ESG means something different to every investor, then to get a common definition of the specific issue is an added layer of difficulty. So getting the ability to select specific factors, the ability to manage the data of across the different data vendors, and then even the definition of the frameworks that the different data vendors are using to come up with their scores. That's another layer of complexity, because some vendors are using the UN Sustainable Development Goals, as Robin mentioned. Some other vendors are using other frameworks. Some other vendors are developing their own definitions and then using those frameworks. Some are using data that is based on deep qualitative analysis, discussions with the management teams, research on everything that's published. Some other firms are are developing their ratings based on, big data analysis, artificial intelligence, tracking news items. So there's very different approaches to defining, to scoring, to and to producing these ratings approaches. So this data challenge then is one of the issues that is actually an obstacle preventing more investors from feeling comfortable investing in ESG. So if you go to the next slide, then there's one of the things that we're doing with clients is we've developed a particular application that is intended to address some of these points. So I illustrate this just as an example of some of the ways the industry is responding to some of the challenges that we're collectively experiencing. So this particular application that we are planning to launch next month relates to the ability to select specific sub-factors, the ability to compare the data analysis across multiple vendors in a framework that is mapped across different vendors. And this approach is intended to make it easier for institutional investors to manage the data, to compare data, and to have a view of what other people are doing with respect to resolving data challenges. So, obviously happy to talk more about this with anybody who's interested in this, but this is an illustration of some of the challenges that are currently prevalent in the industry because there's a lack of standards, there's a lack of data availability, and there's a lack of consensus about how to approach some of these issues. So if you go to the next slide, then once you have a set of data that you're comfortable with respect to, for this particular security, I'm focused on, environmental risk, and I'm focused specifically on, water stress, or whatever is the specific set of factors that are important to your firm. Once you have a set of data that you're comfortable with, then there's the use cases of, okay, what do you do with the data? So if you are managing portfolios yourselves, then you are, thinking about that in a portfolio construction mode. If you are largely leveraging external managers, then as an institutional investor, you need to compare the ESG issues across multiple managers and look at it in the context of analyzing your portfolios. And so we're working with clients to illustrate some of the ways you can communicate some of the ESG risks and positive and negative tilts in the portfolios relative to benchmarks that are resident within your portfolios. So these are some of the approaches that we're seeing in the market, and some of the things that we're doing to help our clients as institutional investors make the progress they want to make with respect to ESG investing programs. So with that, let me pass it back to the moderator to open it up for questions.
So Hank had a little bit of a technical issue and his power went out, so I will be handling the questions. We have a few. The first one is, what are some of the most currently challenging issues in ESG investment analysis?
Robin, you want to take that one as a portfolio manager yourself?
Sure. No, I think I'm going to follow on, Francis, from where you just left off, which is data, right? I think at this point now we kind of know the big factors out there, right? We've seen we have social struggles, we've seen we have environmental challenges, but how do you track performance on these metrics, right? And even if you have one of these wonderful, we're an energy company, we'll be carbon neutral by the year 2030. What does that really mean? Does that mean you're emitting less? You've bought carbon offsets? And then even then, how are you counting the molecules? Because capturing emissions, you can't see this, it's a visible gases, right? So there is a number of issues. And then beyond that, once we actually get the numbers, I did a call with an unnamed energy company who claimed they had reduced emissions by 54 million metric tons. And I said, stop, I don't know what that means. Like, is that good? And so, I mean, we need to find ways to get better reporting. It needs to be standardized. So if everyone's reporting things, I think that's, you know, where we'll get better efficacy as an investor. And so for us, our personal thing has been to think about it in terms of intensity ratios. So if you can think about it, right, we want data out there, but like I said, the data, if it's interpreted differently, or if it's a large company versus a small company, it's hard to understand. But, you know, Wall Street, in its infinite wisdom, has embraced ratios like PE ratios, like a price to earnings ratio. So I can tell you if a company is expensive based on what we're paying for it relative to its earnings, and that ratio is applicable for small companies and large companies, right? And so for us, we're thinking about it the same way. If you're looking at a utility or an energy company, you know, what is your emissions profile for every unit produced? So every barrel of oil you make, how much is water emissions? Sorry, how much is water usage, and what is the emissions profile? For a utility, right? For every kilowatt hour they produce, what is their emissions profile? And so these are, in my mind, elegant solutions. But even then, we have a huge gap from what Francis highlighted, is that the data is just not there yet. And we have a huge disparity because some companies are large and they're under the microscope and they're reporting. But right, most of America is small mom and pops, and they're just not doing that kind of data. And so I know I can't manage what I can't measure, right? And so I think the biggest challenges that we face today as an ESG savvy investor is just getting good data and disclosure. You know, we can do qualitative assessments, and we do those all day long. One of my favorite stories, and I'll keep it brief, was, you know, I was known for being an ESG investor before it was even, you know, a thing really. And, you know, I had this instance where I met the CEO of a coal company. He was a coal mining company. And, you know, sitting across this guy, like, I just palpable. The guy was just gross. He was a terrible human being. He told me he wanted to pay the EPA fine as opposed to fixing the mine that was causing the problems. And I couldn't believe he was saying these things out loud. There was no metrics there. There was, right, it was all human intuition, but we said, this guy's taking way too much risk. We're not interested. And literally 3 months later, he blew up and killed about 27 people in one of the worst mining accidents in North America. So, you know, this important, I'm highlighting this story because it's right, it's important, it's critical. There was no financial metric that said he was going to have an accident in the future. And many people were invested and said, I didn't know. We were invested because we did our homework and we went and talked to the company, and we got all kinds of really negative flags going everywhere. So the biggest challenge is how do you stay informed on that non-financial you know, analysis when really the data is just not being disclosed, and if it is disclosed, right, it's hard to compare. So really, the biggest challenge is just really getting your arms around what can I use to actually make a decision with.
Yeah.
Thank you, Robin. Okay, next question. Are there any sectors where this is a bigger deal, the investment analysis?
I'll go real fast on this one. I know that Francis has thoughts here, but we mentioned this briefly earlier. It's about materiality, right? It's and so if you're a you know, BNY Mellon and you're a you know, a global financial company, and you know, your emissions profile is just not that interesting, right? You know, it is interesting for us as global citizens breathing the air, right? But you know, relative to what Mellon does, it's just we're not going to have a big change on our carbon profile, right? As we try to sell more units of whatever BNY Mellon sells, investment services, it doesn't really impact our carbon footprint. But for a utility or an energy company, as I mentioned, oil and gas companies, right? Every day they go to work, they're putting the planet and people in harm's way. So environmental and safety performance is extremely critical. So yeah, it really depends on what sector you're in. So everybody has an ESG. No one's free from ESG considerations, right? Francis has talked about maybe about governance in a second. No one's free from that, but we will focus on whichever issue is most material to that company. Where can it really represent an outsized risk to those financial numbers?
Yeah, that's a good point. And just thinking about environmental topics, the energy sector, certainly, you know, that's a material factor for the energy sector. And if you think about you know, what does that mean and what do you do with that, then there are some ratings vendors and some investors that would be focused on the issues of which of these companies are investing the most in renewable energy. And so if you think about, like, you want to tilt your investments towards companies that are investing a lot in renewable energy. But if you also want to tilt your investments away from companies that are currently emitting the most carbon, from their current operations, that might be the same companies. And so it's, you do have to decide what is a priority and what the definitions are that are relevant for you. Beyond traditional investments, though, we see a growing interest in ESG analysis with alternative investments, and particularly a lot of public pensions hold an increasing allocation to private equity and real estate, and in infrastructure as well. And in infrastructure and real estate, there's a big focus on environmental disclosures, and we're seeing a greater interest in environmental stress testing as well. So that's an area that is, I think, growing in importance. It's an area that is challenged because by definition, a lot of the information is private. And so as much challenge as we have with the data analysis for publicly available companies and publicly traded companies, there's relatively more disclosures that are available to the public. If you're trying to do the analysis for private investments, you have a challenge in even getting the data to begin with. Certainly, you probably don't have as good data about the investable market and about the common definitions. What we see a lot of our clients doing themselves to manage this particular issue is just getting the information through surveys, asking specific questions that are relevant to their own firms, and then you can kind of get the responses from the individual managers that you have the relationships with. It's not, it doesn't lead to great industry analysis, but it's an approach that we see a lot of investors pursuing currently.
Okay, thank you. We have time for probably about 2 more questions. How do you engage with companies to get them to improve their ESG risks?
Robin, I think that's for you.
Yeah, sure. I'll start with that one. Gosh, there's a number of ways. I think Francis mentioned, the engagement takes all kinds of forms, right? And so we do have proxy committee, which essentially is the group that represents, all of the stakeholders at Mellon, whether it's our clients or, Mellon's positions as well, in terms of how we will vote at shareholder resolutions for companies. So this is essentially, our chance in a democracy economy to actually to weigh in on a company. And so that may be our heaviest tool in terms of engagement. Whereas if if there's a shareholder proposal and that we don't think the company is behaving appropriately or what have you, we could vote against management and have a fairly sizable impact. So that's a very large piece of engagement right there. But as Francis was alluding to, engagement takes all kinds of forms. As a portfolio manager and former analyst, I try to see every company that I'm invested in, between 2 and 4 times a year. I consider that engagement. I'm definitely trying to take as much information as I can from them, but I'm also sharing with them. Here's what I heard from some of your peers. Here's what I'm hearing from this other company. Does that make sense? Is this best in class or not? And I'm actually seeing this company doing a better job than you guys. Can you be more like that company? And so that's fairly soft touch engagement, but it's definitely engagement, right? We're not just a passive investor. We do have that here for some clients, but as an active investor, that's definitely a level of engagement. And then one that I've been a fan of, maybe I'm a little old school, but I love writing letters. So I have a couple of issues that I had with energy companies and utilities where we weren't getting enough disclosure that we liked. They were disclosing, as I mentioned, 54 million metric tons of carbon saved. I told them I don't know what that means. I said, hey, if you can put that in a ratio and put it in an investor presentation instead of buried in your website, that will be more helpful to me as an investor. I'm willing to pay more for a company that has less lethal liabilities. If you're not going to spill and blow something up, right, that's a better investment. So I'm willing to pay more for those. And so that's what the letter suggested is, hey, look, we're watching you. Our clients care. We care. And we want you to do better. And we will invest in you if you do better. But I need to know how to get there. And I need you to help me with these metrics. So we view that as probably what we will call is probably our more preferred action of engagement on a go forward. Proxy can be a little heavy-handed, and because you are voting against it, it is kind of that is the end of the road. And of course, just having conversations with management's the other side of that spectrum where it's very soft. So somewhere in between there, we like to say is we're talking to the companies, we're working with them to get better. But if we're not getting more productive, we do have the ability to take it to proxy and really make our impact felt.
Yeah, and thinking about impact, another form of investing that I think is relevant to some of the public pensions that are increasing their allocations to private investments. There are a growing number of private investment structures that are defined as impact investing that are not just philanthropy. The impact investing is now often offered as an investment option that is expected to offer a return as well. So we do see that. I mean, that's a totally different kind of engagement. It's sort of direct investment in something that might not happen if you don't invest. So that's a very different form of engagement that can also lead to impact investing.
Thank you. So our last question, how much does this investment analysis influence your total investment decision, including more traditional financial analysis?
So I'll jump on this one quick. So again, for us, it's about where it's material. And so for me in energy companies, I spend a lot of time worrying about their environmental footprint and their safety track records. So safety track records at the first glance may be like, hey, look, they may not actually get that much from an actual liability. Most of these accidents are small. They're like, nicks and cuts. But my thesis is that if you're getting nicks and cuts, you should probably be operating a little safer. And so I view the safety performance as a predictor of larger accidents, right? And so that's one we will incorporate it in a pretty big deal. For utilities, right? Utilities, they're required to report emissions, so we get good emissions data from them. And there's a lot of renewal mandates out there, and so they're supposed to be getting cleaner. And so if you can very quickly look at these companies, and you're now starting to see their valuation, their multiples reflect their footprints. And so yeah, this is becoming a much bigger aspect of how you look at utilities. And what's kind of interesting now is I'm also a bit of a math nerd as well. And so we've been looking at decomposing the risk factors in the market. And what that means is you basically take the trailing return of the market and you do a multiple linear regression. So basically a mathematical way of dissecting that return into what you think the principal components of those return were. For instance, you can say a big component of that has been the Fed adding liquidity to the system. So you can use interest rates to be a predictor of that performance. And you can decompose it. Large caps, technology, things that have been working in the market. What we're starting to see now is that some stocks are flagging what we call a blind risk, which means that the model is finding a piece that it can't explain, and it's getting larger. And I have not done the math yet. We haven't finished it yet, but I'm looking at the companies in there, and without a doubt, it's sustainability and ESG. So if you look at some of the companies since the pandemic has transpired that are breaking out, making new highs, there are companies, I don't want to put my number out there, but there are some technology companies out there that are breaking to new highs because they're a sustainability story, right? They provide communication to the masses. There are companies out there that provide wind and solar. And as I mentioned, the big energy companies are trying to save cash as the oil prices pulled in. They're still investing as hard as they can in wind and solar because they view that as a great option for them, right? And so those stocks are breaking out to new highs. And so my belief is that there is now this blind factor in the market right now, which is sustainability and ESG. So yes, it's a big factor for investments. It depends on where we're looking at it. But where ESG factors represent a larger risk, right, it's also a larger opportunity for our ESG analysis, and necessarily means it's a bigger factor of our investment decision.
Well, thank you, Francis and Robin, for your presentation and your insights. We really appreciate it. And thank you for everyone for joining today. Please join us next Tuesday for our next webinar entitled Cash Flow Matching, Balancing Short-Term Needs with Long-Term Investing.
Thank you.
Thanks, everyone. Take care.